Hello, welcome to another episode of Test, Optimize, and Scale. Excited to have Douglas Ruark here with us today, president of Regulation D Resources, a top name in equity crowdfunding across Regulation D, hence the company name, of course, also Reg A+, I believe Reg CF campaigns as well. From the SEC filing and offering preparation side, also software that's powered over 500 of these campaigns. Douglas, thanks for joining us here today.
Absolutely. Thank you for having me.
Excellent. And I know we work with a lot of the same groups. Your software plugs into some of the largest platforms in the industry. So I'm well acquainted with what you do, but want to familiarize the audience a little bit. I thought we could begin with your story.
Absolutely. Regulation D Resources started in 1999. I was a founder of the company, and our goal back then was to try and democratize access into doing Regulation D private placements. It's funny, there's a lot of mystery around private placements back then, and we didn't have the options that we have today. So back then, really what we were trying to do is create pathways and create a service that would allow small, medium-sized businesses to execute Regulation D offerings more effectively, or cost effectively, certainly. And then also just try and give them the resources so that when they launch their offering that they could be successful, access to broker dealers that sell and what have you. Back then you were talking traditional private placements. We didn't have 506C, we didn't have Reg CF. Reg A was around, but it was, the old program that was cumbersome to use. So that was kind of the genesis of the business. We did, PPM preparation, general offering preparation, filing work, but we really geared ourselves towards trying to help small and medium-sized businesses. And a lot of it was education, Jason. I mean, a lot of people didn't realize that there were rules that applied to them going and raising money. Over the years, we executed a lot of work. We've done over 5,000 securities offerings in the 23 years we've been around. We lobbied very hard for the Jobs Act changes. In fact, we started lobbying the SEC back in 2002. And especially as we saw the internet develop and wow, what a great tool to be able to get exposure for a securities offering. But under the old Reg D programs, you couldn't use it. You weren't allowed to generally solicit. So we were really excited to see the Jobs Act pass, see Reg, crowdfunding come out, see Reg D 506C come out. Those were really impactful programs. And then one of the things that we did in 2015 was we saw the need for the capability to use websites to engage investor prospects and take and track them through all the investment processes. So we developed our V1 of our portal system, which was a system to engage prospects. We would have an initial front-end engagement page, and then our back-end software would take and track them through accessing the PPM docs, the exhibits, the filing. From there, there's an invest feature that takes them through the investment subscription process, execution of all the sub-docs, their verification, payment rails, and then in the back end, we also built in Investor Relations Hub, so that ultimately then you use the portal beyond just administering the offering. And now that's kind of a default, using that kind of technology for these kinds of offerings, and especially with the CFs and the Reg A pluses, where you're dealing with a lot of times thousands of smaller investors, and you have to use technology like that to be able to engage people and take them through the process. Ultimately, what's happened is as we've stepped into doing Reg CF work, and as we've stepped into doing Reg A plus work, we're now integrating with other vendors as far as payment processing and integrating with transfer agent systems. So it really was a unique aspect of our model, was that we had the ability to do filing work and do offering preparation work, but that we also had this technology angle that we're able to build these web portals and do all the integrations to provide that kind of tool to our clients. And then at this point we cover all three main exempt offering programs. So we do Regulation D work, we do Reg CFs, and we do what we call direct Reg CFs, where there's an independent FINRA broker dealer serving as the intermediary. And there's some real benefits there, which I could chat about. And then we also do Reg A plus, and that the changes they made and enhancements to Reg A to create Reg A plus has just been amazing. And that it's not a perfect fit for everyone, but for a lot of companies, a Reg A plus is really going to give them a legitimate vehicle to go to market with. It's going to mimic the investor acquisition capabilities of a public offering without putting you through doing a public offering. And obviously, it gives the capability for firms like yours to be able to really leverage a marketing campaign and get massive exposure for that client's offering. And then, the best part, everyone can invest. The second grade school teacher, the orthodontist, it doesn't matter, non-accredited, accredited, everybody can participate. So it's an exciting time, in our industry. And I think there's a lot that's dovetailed together between the technology enhancements, the enhancements with the programs themselves, and then the ability to market these offerings and target and track people and really be able to get exposure for it in a meaningful way and raise money.
Absolutely. It's like you said, to be able to democratize the access to these deals for investors, to be able to reach and market to these audiences for the issuers, the brands themselves. And obviously, we play a large role in that. We champion that concept as well. And the fact that you've been able to do this across so many different initiatives with so many different groups, speaks worlds that that's what the software was built on. And curious, let's say a founder comes to you. What is the process? How do they determine which vehicle to go down? I know there's variations for Reg D, as you were mentioning, Reg A plus, Reg CF. I know that the timelines vary drastically, and even some of the resources that are required to go live using one of these filings. Where does the conversation generally start, and how do you guide teams that are looking to raise capital online?
Yeah, that's a great question. Certainly we get people that come in that know what they want to do. I also get people that need guidance there. One of the first things I ask them is how much capital are you raising and how important are non-accredited investors? I might get a client that says, hey, I've got family office money and some institutional clients, and we just need a filing and a vehicle to process these security sales. But we're not going to have any non-accrediteds, and we may not even need to go out and generally solicit people. And in that case, then they're going to go into probably just a typical traditional Reg D offering. For people that clients that need to raise larger amounts of money, and I usually look at it from 5 to 10 million plus. They're going to start probably looking at a Reg A plus, and especially if they want to be able to raise money from everyone. And a lot of times it's the fit there is as perfect as it can be. I mean, a lot of times you get clients that come in and say, hey, we've been operating, we got a web company and we've got, 40,000 people in our affinity groups and, all the things that you guys, I'm sure, love to hear, like, oh, we're going to be able to target that very effectively.
Oh, yeah.
But they come in the door and then it is kind of an easier fit there, which is, all right, well, look, you're going to need to be able to generally solicit. You're going to need to be able to accommodate accredited and non-accredited. You're above the CF limit. You're going into Reg A plus. Part of it also comes down to timing and cost. Certainly, a Reg A plus filing is going to be more expensive and it's going to take longer. It's a quasi public offering. So, and the filing work that we do is akin to an S1. So, yes, it's going to take longer. It's going to take more money. It is going to be a vehicle that's going to provide better capabilities by far over something like a Reg D if you're looking to raise larger amounts of capital.
Mhm.
Part of it can also come down to things like, as far as the cost stuff, is also things like audit. Like you do a tier 2 Reg A plus, you need audited financials. If it's a new real estate fund where it's a brand new entity and it's just an opening balance sheet audit, that's not a big deal. If it's a 12-year-old company with 4 subsidiaries and and they've never had audit done, they're going to have 2 full years and a balance sheet, and that could get expensive. That could be 20 or 30 grand to get that done for them. The CFs, where I see the CFs fitting in, we see clients that come in where they may just need to raise 500,000, 800,000. They do have an affinity group. They have a customer base. They want access to non-accrediteds. That's where CF really is great, is on some of those smaller deals. Obviously you could do a CF up to 5 million, but part of the criteria that needs to be looked at is once you go above a million 70,000, you have to have audited financials. And I think when you start getting up into the range of a 3, 4, or $5 million CF, and you start factoring in the higher commissions for the intermediary broker dealer, sometimes you have to look then at Reg A, because if it's a $4 or $5 million offering under CF, you actually might come out better with a Reg A. You'll spend more to put the Reg A in place, but the
Right.
commission impact at the end of that process, I mean, you're 3%, 4% for an intermediary on a CF, doing a direct one with a broker dealer intermediary. Most of those same broker dealers will admin a Reg A for 1%. So that's something else that I'll get them to look at is, if you are successful raising $4 or $5 million with the CF, and comparing the costs, you might actually come out with less cost on the capital going under Reg A than you would a CF. So a lot of it, there's a lot that we kind of juggle there with clients, and they're good conversations. Part of it also just comes down to, what kind of vehicle do you really want to go to market with and spend your time with? That's the other thing I get them to look at is, hey, you're going to go syndicate capital, and you're going to spend time, energy, and money to do that. So is it worth it then for you to spend more to put a better vehicle in place? That's something that they really have to look at, because time is money. So if they're going to out, you know, pushing a marketing campaign and trying to syndicate capital, they obviously ought to have a good vehicle to do it.
Yes, and time is often an overlooked aspect of the equation here. I hear cost of capital, how much can be raised with each vehicle, whether it's 5 million on a Reg CF, a side by side Reg D, and where that can increase it to the 75 million on a Reg A plus. But then I still look at the success rates and not quite where they need to be, let's say for Reg CF, a lot of data around that. On King's Crowd, I know Reg D, Reg A plus, use of broker dealers, institutional capital at times, things along those lines are more common, especially for some of those larger Reg A plus campaigns, as you're mentioning here. But the timeline, when how do you direct the time ranges to issuers and when they may be able to complete this round?
Sure.
For Reg D, is it more of, and Reg CF, is it similar type of timelines, and Reg A plus doing the full 12 months? Well, what do you typically see?
Yeah, I mean that. Obviously, a lot of that's going to be driven by the amount of capital they're raising.
Mhm.
Certainly, someone raising, 40 or $50 million is going to have a different timeline, obviously, than someone raising a smaller amount. I mean, I think on the prep time frames, Reg Ds and CFs are usually going to be about 60 days to prepare one of those, get the Form C done. In the case of a Reg D, get the PPM drafted, Form D in place, get the technology component done. So, usually on prep side, CFs and Reg Ds, I'm typically telling people, plan for about 60 days to get one prepared and ready to go. Um, Reg A plus, you know, I mean, it's 90 days at least typically to get a Form 1A drafted, get all the exhibits in place, get all the, opinion letters, audited financials, get all that stuff in place, get
Oh
the
yeah.
client sign off, and have it ready to go to the SEC. Deals that are more complex, sometimes it can take even longer. The other factor there is then SEC submittal in the comments. We've got a really good track record for our no comment. We have about 70%, 75% of our submittals are no comment qualifications. And so, but that, if you get stuck in a couple rounds of comments with the SEC, you could easily eat up 6 to 8 weeks there as far as responding in the back and forth. And that's part of the thing with Reg A that I tell people up front, that you do have to plan ahead with one of those, because you're not going to be out raising money typically in 45 to 60 days. And then as far as just the timing on raising capital, a lot of it really comes down to I think the budget and the sophistication of the client. What I tell people is you're gonna, for most clients, you're gonna pay one way or the other. You're either gonna pay to get the marketing out there and have a
Yep.
sophisticated marketing campaign where you're getting eyeballs on the opportunity, or if you're able to, you're going to be paying a broker dealer 7 to 8% to sell it to their clients. But one way or the other, there are some of these unicorn clients that they just happen to have really deep affinity groups. They've been out maybe selling a product for a while, and they've got tons of people in their Facebook and their LinkedIn's and customer base lists, and they can very successfully raise money out of those groups. But A lot of companies don't have that. And in that case, then, as they've got to generate that traffic, by spending dollars. And so that's part of it too, is just for the client, how aggressive are they with that? And if the offering is successful, are they using funds from the offering to then bolster that marketing campaign? I'm surprised a lot of times by the number of people that don't know you can do that. And you clear your minimum offering amount. If you've line itemed into the filing that you're going to use some of the proceeds for marketing the offering, I mean, that's available. And why not? Take some of those funds and start getting even more eyeballs on the offering and the investment opportunity.
Do a rolling close, use that disbursement to reinvest into the marketing. The campaign's working, people are investing, you're on path to your raise goal. So reinvest into it. Absolutely.
Yeah, and I've seen too people where ideally they're going to need a reg A. They need 25, 30, 40 million over a 36-month period of time, but they may go ahead and prime the pump by doing a CF. So they'll do a 2, 3, $4 million CF. They'll get themselves capitalized. They'll have a war chest then for that reg A, so that when they launch the reg A, that they're going to be well capitalized for it. So I've been seeing more and more of that as well, where we'll start a client with the CF, and then they'll roll into a reg A, as needed.
Yeah, we'll often see that game plan from issuers that we work with or just speak to. There's ones that we advise and don't work directly with, but share notes with. And some groups will even come from reward crowdfunding, do a Reg CF, add a Reg D, move the accredited investors to that filing compliantly, then set up to do a large Reg A plus. We've worked with groups on 3, 4. We're about to launch a 5th round for one group that's done all 3 filings with us. I know there's sayings in the industry such as always be raising. So I have been able to map some of that out with issuers. And a big component when we're speaking to groups is, what is your existing audience size? What is the pool of investors that could potentially invest here? Whether we're talking accredited, whether we're talking retail, what does that mean for marketing needs? And directly, as you're mentioning, if you don't have that cohort available, prepare to do a lot of marketing, build an audience, have them go from the awareness stages of the funnels to considering the deal, intending to invest, actually participating. Reg CF, even Reg A plus deals, we'll see multiple investments at times, especially when a round's closing. We'll see peer-to-peer marketing from the investors where they're bringing in friends, bringing in family. But either way, make sure you have enough traffic getting to your offering is something we really get out there. We really preach. And looking at marketing costs, I know there was a number thrown out a few years back of 10%. And what that means is when everything's working, anticipate spending around that on marketing. This is more for Reg CF, Reg A plus, and based on check sizes, transactional value. So you could determine how many investors you'll need to bring in, how many of them realistically can convert at a given budget level. We've seen groups do it as low as 2% in advertising spends and close their round. More of a 1.07 million Reg CF. We've seen groups do it at 20%, but when they came to us, they were plateaued. They were unsure whether the entire round was going to work at all. So being able to see some traction and do it successfully was meaningful to them. But I know being able to project high in terms of budget, spend less is ideal. I want to be able to do what's necessary to hit that goal. Project conservatively when it comes to performance. Don't think just by being featured once you're going to be able to close the entire round, is a lot of the messaging we get out there. Do you see similar types of recommendations for issuers, for founders? Are there other types of aspects that they should take in when planning the rollout of this raise, the overall marketing of it?
Yeah, well, and to touch on something that I think is interesting, because it's funny. I have to unwind this with clients that have maybe done a raise 10 years ago, and I get that. I have like a real estate fund client, and they come in and say, "Well, last time we did a syndication was 2009," and what I have to unwind sometimes with them is the mentality that, well, we only want a handful of investors. We want a $250,000 minimum subscription. We don't want to deal with a whole bunch of investors. And that's old school thinking. And, I think part of it is just that the technology to manage investors well has dramatically changed in the last 5 or 10 years, especially in the last 5 years. And so you shouldn't be afraid of having, there's nothing to be afraid of to have couple thousand people, 14,000, 15,000 people on your cap table. And there's plenty of examples out there of companies that have gone from a handful of shareholders to even tens of thousands of shareholders. They're still a small company, and yet they're managing it very well. But the point being, something that you mentioned is that peer-to-peer aspect. You go to do a second round, and you have 2,000 shareholders, and they're invested in the company, and you launch a second round, and they're going to bring their golfing buddies and their college friends and what have you into the equation. I mean, as long as they've been happy with the investment and the progress of the company. And so ultimately, that's also a mechanism and a tool for being able to capitalize on these additional rounds. Is you have this sales force essentially that's there, of people that want to support the company. Hey, we're doing a second round. You've got money with us. We're progressing. We're moving forward with the business model. And so that's something that I think is important, because I do get people that come in from that old school mentality of we just want small number of investors, but yet they're coming from an era where there wasn't really the technology to manage as well. And then I think the other thing is that the programs that would allow you to democratize investment from smaller investors really wasn't there either. I mean, you were stepping up to you were essentially going to have to step up to something like an S1 if you wanted that capability. And now there's obviously streamlined options that give you that capability. So I think that's an important thing, is to keep in mind, is that, there's some great technology out there, and that, don't be afraid of having a lot of shareholders, because ultimately they'll help you grow, and they'll help you actually close, additional rounds of funding.
And I echo that. The fact that you pointed it out and work on all of these different types of campaigns across the spectrum, Reg C, CFD, A plus, and are able to state that. I've spoken on that topic quite a bit, of the premium audience actually being, in many cases, a user owner, tapping into a customer base given the company, or just a large pool of ambassadors, as you're mentioning, who are going to be talking about it at the next golf tournament. They're going to be speaking about it. Hey, this is what I participate in, and listen to this investment I just made. You should check these guys out.
Yeah.
That type of mentality definitely resonates on the next round. We even look at the metrics on how it's working for our campaigns, which incorporate advertising, content marketing, direct outreach to a large degree. And I'll see about 20%, 50% of the investors come from these digital channels directly. And then another portion occurring organically, whether that's peer-to-peer marketing, some write-ups as well too, if they're on a portal, getting attention from the portal's audience, as those investors are seeing that line around the block on that deal on the portal, such as Start Engine, WeFunder, Republic, those types of platforms. Even some of the financial publishers and what they're able to do for groups that are listing on their own site and showcasing what's moving in the space, but having that social proof around it. So it looks strong to anyone who's looking on the deal. If you have 1,000 investors, 2,000 investors, there's probably a reason why.
Yeah.
You're leveraging their voice. And I've heard from founders all different types of opportunities that have come from their investor base, from strategic partnerships to B2B deals, various types of press. So I definitely would prefer the larger audience. I know there's aspects, there's risks that are tougher to accomplish that. We certainly have worked with the Reg Ds with a 250K minimum, and we're doing lead generation for a commercial real estate project, as well as the 10 to 25Ks and the 50 to 100K minimums. We understand the return can be stronger there. We do look at it as a bit more hit or miss, and really want to have an understanding on the IR, the investor relations process, and what's occurring for those rounds, so we could gauge how well the digital marketing is going to do, how effective it could actually be. Because on any of these, it's in the follow-up. I've learned, whether it's retargeting from an advertisement, more of the old school follow-ups, and how to really convey more value and immediacy throughout those discussions. But I've seen success across the board, and the founders that talk about the benefits of those audiences later on tend to be the happiest.
Yeah. Well, and I tell you too, more and more of average investors, are interested in these opportunities. And I mean, it's funny because you look at a show like Shark Tank, right? Massively successful show. But the funny part is it really did introduce people into the concept that the average everyday person could invest into these opportunities. So you watch these Shark Tank opportunities, and they do the flashbacks where it's like, all right, well, they got a $500,000 investment, and 2 years later, they're making $20 million a year with a sponge, right?
Yep.
Um,
Yep.
and but I think it's interesting because people now realize and are, with the crowd, especially with the crowdfunding push, they're realizing, oh, I don't have to be a shark. I can invest in that stuff. I could go find an engaging, high growth company that's early stage, and put money into it and be an investor. And I just think that's been an interesting aspect of it, that more and more people are just average everyday people are looking at these kinds of investments. And again, it just, that's where the tools, especially a CF and an A plus, where it ends up being a great tool because there are a lot of people out there. And part of it too is like, you look at like social impact deals. I mean, we do a lot of med tech work, and the med tech stuff, social impact. So you've got a treatment, or you've got a product that's going to solve issues for people. And those, you'll get investors where, if they get a return, great, but they're coming from a personal standpoint where, hey, I had someone that had this issue, and if this treatment solves that issue, or provides a better pathway for recuperating from it, I'm investing just because I want to see that get on market. And again, I think that's what's interesting about what you guys do, is being able to take a look at a company and say, all right, well, how, where are we going to push this? Because like, so on something like that, it might be like, oh, there's going to be, doctors that are using this technology. All right, well, that'd be part of where you're going to target it, because they're going to understand the opportunity, they're going to understand the benefits of it. So I think those are interesting too, where you get those kinds of deals where it's not a plain vanilla type deal like a real estate fund or something. It's something special. There's something unique. There's a social impact angle that can be leveraged as far as the marketing goes.
It's new, different, has a community impact. Absolutely. And when I've polled investors, a lot of them have gotten involved on, let's say, Reg CF campaigns for the experience of it. Hey, we want to be part of a group that has this social impact. We want to be adding this to our portfolio. And to see that surge of retail investors hit the market in 2020, once the shutdown occurred, digital numbers were up, and the amount of retail investors that entered the market increased their transaction frequency on the market, the impact that had on accredited investors who then wanted to dive in and explore and get more acquainted with some of the opportunities that are alive online. Like you said, it's been amazing to watch. And I think there's going to be more and more investor success stories that are going to attract additional audiences to it in the years to come. I see the issuer success stories like that Shark Tank follow up all the time. And we get to be a part of that with many of the groups that we work with and see their offices grow, their team count, their operational costs, and how that impacts their product in a positive way. So we've been able to watch that firsthand, have seen some of the investor uh, benefits, returns, growth of their positions already occur. But I think more and more of that's going to come, and that will be a bigger part of the headlines around it. But wanted to ask you a few questions, as you are a wealth of information. I went through a full page of notes that I'll be sharing with my team here internally. Hope listeners are doing the same. But thought I'd ask, for any group that is preparing to do one of these raises, what should they test out? What should they make sure to incorporate into their game plan? I know we've talked about some of the timelines for the filings, but what else do you see as something they should at least explore in terms of implementing into their model?
Sure. Well, the first thing I would say is, and this is just related to the preparation of like the filing work and what have you, is come in with good
Yeah.
information. We have a lot of people that will engage us, and I mean, who doesn't want to get out and raise money as quickly as they can? And yet they come into the process and they maybe don't have good corporate information, or we run into a lot of corporate cleanup issues where there's no employment agreements between senior executives and what have you. So I would say the first thing is come in prepared. Part of what they may want to do too is work on really identifying weak points within their pitch. Work on pitches to people that are savvy people that have maybe done investment before. Because we actually get put in that position sometimes where we're kind of looking at where's the strong points in your business model, but where's some of the weak points, and then how can you address that? Like, for example, we run into companies where they've got small management teams, and you could then effectively build out a board of advisors where they're not even in a situation of board of directors where they have fiduciary responsibilities, but it's an advisory board. But that advisory board could bring needed talent to backstop a small management team, for example. So those are the things that I think I try from the test standpoint. I try and get people to look at, which is, hey, kind of switch around and put yourself into the position of being an investor. Critically look at your deal. Where do you see weak points? And maybe, like I said, maybe it is something where you have a small management team and people may question the ability to scale the business. How do you mitigate that? There are ways to mitigate.
Almost positioning the company for that pitch. Hey, this looks a little weak. Let's strengthen up the team. Let's bring on some advisors. Let's really make this deal more attractive before taking it to market.
Yeah, I mean, a lot of what we run into too is valuation, and obviously,
Okay.
valuation is tough, right? I mean, everybody's got an opinion on their company, and um, I would say that's also where they may want to really get good outside expertise, because I found it's hard for people that are emotionally invested in the business, founders and principals, a lot of times to make accurate decisions on valuation, and rightfully so. I mean, that it's their business. They put their sweat and tears into building it. But a lot of times that's a failure point, that they go to market with something that the business model is attractive, and the growth potential is attractive, but they've just priced themselves into the stratosphere as far as their valuation goes. And they don't know it necessarily because you got three principals, and they all think it's a great valuation. But so that'd be something else I would say is work to maybe get some unbiased outside opinions on your valuation, because if you go to market, you spend all the time to put an offering in place, you get Jason on board, doing a marketing campaign, you
Yeah.
spend all this time, you spend all this money, but if your valuation is not within a realm of reality. I mean, and sometimes these are. I mean, I see stuff where the valuations, I look at them and I just say, I don't know how I could invest into that, considering where you would have to be positioned 5 years from now or 3 years from now for me to make a return. That would be a big one, I think, is getting some real good unbiased outside counsel on what the valuation is.
Sure. Make sure it's realistic to anticipate growth. And in the very conservative timelines that you put out there, I think those are great things that should be explored, have the right professionals brought to the table. I know on the marketing side, we are always open to calls. I imagine your team are as well, other experts in the field. We all want to see a higher success rate industry wide. So the resources, the information is out there. What about during the live raise? How can groups optimize? Whether they're not seeing performance right out of the gate, they need to move some things around. Maybe it has to do with their filing, maybe it's their marketing. Something has to change, or just optimize as a whole. Maybe the timelines aren't quite there. They're seeing traction, but they need to do it quicker. What insights do you have towards optimization?
Sure. Well, I mean, the first thing I would say is obviously get Jason on board to do your marketing. I mean, I say that because look, I have people that engage us, and they kind of have that mentality of, if we just have the vehicle, that will be successful. So from an optimized standpoint, they head out with this vehicle, but they don't know really how to set up a marketing campaign. They don't know how to target. They don't know how to adjust. They don't know where to deploy the marketing, what kind of content to put out. So, I mean, the first thing I would say is if you're going to go through this process, obviously, I mean, get professionals on board there. I would say then the other thing is listen to feedback. because again, like driving back to that valuation issue, if you have an issue, if you're not raising capital, if you've got a campaign that looks like it's going to fail, I mean, listen to the feedback, because you might get feedback from people that would tell you where the sticking point is. Maybe it is something like a valuation issue. I think the other thing is what I mentioned earlier as well, which is if you have a minimum target amount, minimum offering amount, you've cleared it. Look, consider writing into the filing that you're going to be using some of the funds to bolster your marketing campaign. I get it. There's companies that come through these processes, especially with the CFs, where they may be on a limited budget. I totally understand it. But be smart then about how you set up your filing, write in the capability to be able to use funds for that, because ultimately maybe they can get past that target threshold organically, and then that gives them the capability to start taking funds to bring on Jason Fishman and to have a legitimate marketing budget. So that's the other thing too, is have that as a capability, because that's helpful if you've got if you've got money coming in from the offering. Use some of it to make sure you're going to be successful.
Amounts in the filing so you could do those rolling closes. And what about scale? You've been part of very successful campaigns. You have a very strong portfolio over there at Regulation D Resources. What have you seen as commonalities across the top raises?
Well, I would say, first of all, obviously having something that's compelling. It's always going to be the business opportunity that's going to drive success, in my opinion. So make sure that you've positioned the company well to do one of these raises and you have something that's compelling. Number two, as far as scale, again, using those invested funds from the offering to be able to really, really push that marketing campaign, I think is big. Because as if you want to go do a 30 or $40 million raise, again, you use that 10% figure, even a 5% figure, you're
Mhm.
looking at millions of dollars that are going to go out as far as the budget goes. So having the capability to redeploy funds from the offering into that, I think is key. And then, don't be afraid to do multiple rounds. And I think that's something else. I think a lot of people target fixate on, we need to raise $40 million, and we're going to raise $40 million, and that we're not necessarily successful if we don't reach that. But look, you raise 15, 20 million, and if you feel like maybe the offering is stalling a little bit, hey, you can close it, deploy that capital, relaunch a secondary. You're relaunching that secondary now with a company that's got a higher valuation, that's better capitalized than it was prior to the round that you just executed. So that's something else I've seen, where people come in and they want to raise 40 or $50 million, but technically the use of proceeds is spread out over 24 months, 36 months. Break it into rounds. It's more manageable. You're gonna have a lower cost of capital. You're gonna sell less equity in the company, because if you break one big round into three, each of those are going to go off at successfully higher valuations. So I think that's something else to look at when you look at the scale side. Is everybody wants to have a successful offering and reach their maximum, but if you don't, sometimes there's a benefit to that, and that is that you can reorganize and reformulate a secondary or a third round, and that follow-on round is going to go off typically at a higher valuation. But again, you also have that affinity group now. All those shareholders that came in through that initial round are going to be there to help bolster going out and raising additional capital.
Exactly. We've seen that to be the case many times. And I think that's a great note to add there towards scale. And Doug, this has been, again, a very informative session, a great discussion. I've enjoyed it. If any listeners want to get in touch with you directly, what is the best way to do so? And what is any final notes you want to leave them with?
So anyone interested in doing one of these offerings, they can certainly, first of all, go to our website, regdresources.com. Regulation D Resources is the company name. You can plug that into any search engine, will come up. But our URL is regdresources.com. You can also call us. Our main office line, 720-586-8610. And my direct line, if you want to talk to me directly, is 720-586-8616. And we would be happy to chat with anyone that's interested about just talking about these programs. Again, it's a big decision to do one of these offerings. And myself and my staff are more than happy to discuss this with entrepreneurs and business owners so that they can make good decisions going forward as far as which program is going to be the best fit for them.
And I would highly recommend audiences to do that. Douglas and the team are filled with all types of great insights, as we've heard on the podcast here today. Love how you gave direct line access as well, too. So definitely recommend listeners to do that. And Douglas, want to thank you for the time. This has been a great podcast episode. Appreciate you hopping on here.
Absolutely. Well, hey, thanks for having me on. It's been a pleasure, and I've had fun.
Awesome. Well, thanks everyone. We'll see you next time. Thanks for tuning in, and don't forget to test, optimize, and scale.